everybody. This is George. How the heck are you guys? And let's go ahead and let's get the show on the road. So last week, everybody said, George, that was a lot of information. A little bit less. All right, totally cool. We were just making up for a little bit of lost time, but more importantly, it's really great information. Like today, we have the big question. We have limited inventory, which really sucks. And then we have our mortgage rates that actually went up. That really sucks too. So how come home prices aren't falling? Why aren't the home values, purchase prices going downward? Well, that's what we're going to talk about today, because there's a lot of things that are going to happen over the next, say, couple of months, and people are going to need to kind of change their mindset of how they do things. As an example, so I have what is called the vacation trifecta, and that is coming up like imminently. And you might be saying, the what? And I call it the vacation trifecta. So first we have Memorial Day that's coming up here in about, let's say 10 days. All right. And then you have kids getting out of school. That's going to happen over the next 3 weeks. So then you have July 4th. Those three events are what we call the vacation trifecta. The vacation because the buyers go on vacation because their mindsets change, which is totally normal. It is seasonally normal, and we will see it this year. Absolutely, without a doubt, it's going to happen. People are seeing the beautiful weather. Buying a home just doesn't become top priority. And it happens every single year. In fact, they start reporting, it's the real estate ghost town because everybody's going out and doing other things. All right. So July 4th, after that weekend, is a great time to go on market if you're a seller, because that's when buyers come back in and they're like, hey, you know what? We need to secure that home for the next school year or for what we're going to do. And so we will see a surge of buying until about the middle of August. What happens at the end of August? Well, first part of September. Well, guess what? We have another 3-day holiday. I think it was Labor Day. Then guess what happens? You bet. Kids get back in school, buyers last minute vacations. Again, we have that pullback. And that takes us through most of September. So towards the end of September, October, our market picks back up again until about, I would say, the first, second week in December. So roll the calendar back from December, and let's look at the vacation trifecta, and knowing that your buyer attention is going to be limited. Pricing is absolutely paramount. Listen, I was just with Chris, one of our team members. We were going through all of the different areas that he is looking at, and working within to refine numbers for his channel, right? Because he is absolutely wanting to provide great information like this. And he's like, oh my gosh, you're absolutely right. If your home sells in the first 7 days, you're looking at 100 to 107% of list price as far as a sales price, money in your pocket. However, you miss that point. Whether it's sentimental equity, you overpriced the home and you got to 20 days. Well, now you're only going to be looking at 98, 96% of list price. So you've already lost dollars. You already lost momentum. Okay. You're having to give up now concessions, and buyers are going to get a little bit sweeter of a contract. Okay. But then if you miss that mark, you go out to 40 days. Now you're only looking at 92, 93% of actual list price. So now you're actually losing even more dollars that should have been in your pocket, because well-priced homes selling within 7 days get between 100 and 107% of list price. That should be everybody's target. And if this does not make sense to you, look, post a comment, reach out to us. I will statistically show you consistently how this is a actual statistic you need to pay attention to. That is super important as you're looking at The trifecta of buyers going on vacation, because it's happening. It is upon us. So, all right, going to get off my soapbox. Let's move on. Now, one of the key things that we want to do, we want to go through the metrics of what we're seeing in today's market, because as we hit the relationship between inventory and mortgage rates and how they relate and what it is doing in this market, this will all make sense as we roll through. So let's go ahead and bring this up. Excuse me. Here we go. New listings, 1,392. The first time since the middle of October that we have actually seen inventory rates higher than pending sales. Is it a surprise? No. Why? We just told you. Buyers are looking at this great weather and saying, hey, let's go elsewhere. And sellers are saying, hey, it's a great time to come on the market. And that's what they're doing. So make sure your price is spot on. How do we know that people are still overpricing? Look at your list price reductions at 384. That took a pretty healthy jump. Back on market, again, that's a pretty healthy jump there to 108. But when we take a look at pending are still doing what they need to do, which is super awesome, right? Now, look at the solds, 927. That is exactly where it should be. And as we roll through the summer, that should creep over the 1,000, about 1,200 homes on our running 7-day average. Okay, so you might say, George, that's all fine and good. We hear you. Pricing is super important. Don't bring in sentimental equity because it has a zero value. Make sure that we're solid on our numbers and we're pulling that emotion out if we want, and only if you want the most amount of dollars in your pocket. Do not overprice your home. And we get that. We want money in our pocket. We're going to listen to you. That's great. All right. So when we move on to our next one, we take a look at this. Let me blow this up for you guys. All right. Super, super important. So as you can see, we are only a few hundred homes off of where we should normally be, historically, at least year over year. We technically, as you can see here, there's 8,399, okay? 8,400 homes. And you can see that last year at this time, we had basically 8,000 homes. All right. That is going to change when we start taking a look at what is happening as we forecast. So as you can see the highlighted section, right? We have May of 2022, which funny enough is the same number today, 7,970. But look at June. We immediately took a jump up to 11,007. Boom. July, 13,000. August, boom, 13,000. September, again, they keep that 13,000. And then all of a sudden, October, we drop down to 12,000. Super interesting because remember I said since the middle of October, we started dropping inventory. Now, part of that is seasonal, but that is before the seasonality because remember, we start reducing listings typically about late September or late November, Thanksgiving, into the early part of December. Now, here's what's super important to understand about that is we should be technically right now between 18,000 and 22,000 homes. We have 8,000 homes. So we're about 10,000, 12,000 homes short of where we should be. So we have a scarcity. Now, this is not new. We've been suffering this for about 10 years, which is shocking. And that's why every once in a while I say, is this the new norm? Well, it'll be interesting to see. But remember, it's economics 101, supply and demand. We have a massive pent-up demand still. How do we know this? Because anytime a well-priced home comes on market today, even with interest rates in the mid-6s to low 6s, you are seeing multiple offers. Now, they're not the crazy escalations that we saw in 2020 and 2021. Why? Well, because of interest rates, and that holds people back. I'm going to get into that just a little bit more. So when we pop over and we take a look at the next slide, which is our new construction, you can see year over year, we are doing actually quite well. And in fact, when we take a look at this, the center column there, and you can see the month in 2022 and the month that we have today in 2023, the solds are only off by 6 homes. However, we have twice as many pending sales as we did. Super interesting. Why? Because even though interest rates are a lot higher, builders are out there and they're offering incentives. Prices are still very competitive, but we have such a low inventory of existing homes or resales that new construction just makes a lot of sense. And so that's why where new construction is historically about 10% of the inventory, we're actually at about 30%, 29%, 30% today of the overall inventory. Now, when we talk about inventory, I'm only talking about single family. I'm not including condos, vacant land, manufactured homes, multifamily. I exclude all of that because let's look at the real numbers of what we need, okay? And understand, we're talking about today, real-time numbers, not what people are talking about now, which is April, considering we're the way through May. And I think that is more relevant. All right, moving on. When we take a look at the next slide, when we talk about banks and REOs, look, we are absolutely, without a doubt, super low on the inventory. We're still one of the top 5 markets in the what they call the sweet spot across the United States. Our inventory on REOs or bank-owned homes, super low. For those folks that are thinking that they're going to jump up and get a great value on a bank-owned home, doesn't exist. Why? Banks are super smart. They know that we have low inventory. They know that we have a high demand. They'll do paint, carpet, and vinyl, put a little lipstick on the pig, put it out on the market, and it will sell. Now, the numbers that you're seeing there, well, that's half of Washington State. 58 homes, half of Washington State. That's peanuts, right? Small number. However, what we are seeing is also a decline in defaults. We are seeing a decline in the forbearance program. So they are doing their workout. So do not expect, there were some folks saying, hey, George, we're expecting some shadow inventory coming in with REOs. No, you're not. And in fact, our area has one of the lowest default rates. And I don't know where you were thinking that you were going to get this big number. And they're like, well, we're taking a look at what's going on in some areas like Arizona and Texas and over in where Detroit is, and Michigan. And I'm like, those aren't even our market areas. So anyway, make sure that you're looking at relevant information. This is free. Remember to subscribe. Remember to like this channel. Share it with people that you like. And you know what? Feel free to ask questions. We normally get back to you in about 30 minutes. Well, except for on Sundays. Sundays, it takes a little bit longer, and sometimes on a Monday, right? All right, so let's take over to our next slide here. Let's talk a little bit about what's going on with rates. So the fixed rates actually went up a little bit. A lot of volatility going on, a lot of bickering and whatnot going on in Washington, not our Washington, but the Washington where the head shed is. And that is having an impact on it because remember, feds do not control mortgage rates. They control your HELOCs, your home equity line of credit, your car loans, your credit cards, and what banks lend to each other on a daily basis. That's what the Fed controls, all right? With everybody else, that is a mortgage-backed security. Watch your 10-year treasuries, watch your Ginnie Maes, things like that. Those stocks are what dictate what mortgage rates are. In fact, you can see here, mortgage rates bopped up a little bit, and this is conforming. This is not investor. Investor rates, I think, are around 6.25, 6.3, whereas this one is almost, 6.9, 6.85. And remember, this is another thing, because it's a stock, right? Just like the stock market goes up and down every day, just like you see it there, so do rates. If you get quoted a rate in the morning, do not think that's the same rate you're going to get in the afternoon. And if you're quoting 2 different companies, make sure that you're quoting that company at the same time, okay? And make sure that the points and the loan fees. Watch the 5 questions to ask when getting quoted mortgage rate on the channel. Be super helpful. Again, there's no marketing, but it will help you understand what you're looking at, because a lot of people unfortunately get caught up into, yes, marketing. All right, moving on. Okay, let's take a look at this. Here we go. This is super important. Short home supply keeps prices high even as rates dampen demand. Okay, basically, Michael did a great report, I think, and he talks about months remaining inventory, something that we talk about quite a bit. And basically, he takes a look at that relationship of mortgage or of inventory as compared to mortgage rates and how the two interrelate. And so when we take a look at this, it says, listen, we note a general decline in the average MRI, that's the inventory, over the past decades. We just talked about that being 10 years, primarily because supply has not kept up with increasing demand. We can also attribute the decline in inventory to potential sellers sitting on the market or significantly below market mortgage rates. Now, what that means, let me just translate this. What this means is people who got their mortgage rates in the 2020 through 2021 part of 2022 actually have mortgage rates below 4%. And in fact, I think they said that 2/3 of the mortgages currently held are below 4%. That's a pretty significant number. Why? Well, as the report says, hey, look, these guys don't want to trade a 3.5%, 4% mortgage for 6%. That financially doesn't make a lot of sense. However, what they're doing, both some buyers and some sellers, are sitting on the sidelines. Now, for a buyer, I think that's not a great idea, because remember, when we see interest rates come down, which you will see that happen, again, it'll be bobbling. Yes, it went up. Yes, it will go back down. Fourth quarter, Q4, we're expecting it to come down. 2024, expecting that to come down, because we're expecting the Feds to pivot, meaning that they're going to take, and instead of increment increasing, they're going to see inflation stabilize. They will actually start to drop, which triggers a recession. Always does, almost always does, I should say, which then drops mortgage rates down. Home values actually go up because buyer demand comes back into it. So if you want to not have as many escalations and multiple offer situations, hey, look at it now. Now, one of the things that they also talk about is the concern of either default at the higher rates or, which is really interesting, the high interest mortgages refinancing down to lower interest. And you might say, George, well, what difference does that make? It's a big difference, you see, because you get all of these banks and they all make, a couple of $1 billion loans, 100 loans here, 100 loans here, 100 loans here. They package those together and they sell that out on the market called a mortgage-backed security. Your hedge funds, your insurance companies, people like that who need stability, right? They will buy them because it's stability that they are getting, right? Because the reality is you're going to pay your mortgage. Go figure. Now, if people start cashing out of that, they refinance, that lowers the value of that mortgage-backed security, which creates concerns. It's part of the reason why they charge some loan fees, and points and add-ons, things like this, so that they can offset that. Okay. Understand, when they're taking a look at inventory versus mortgage rates, the two go hand in hand. And that is very clear in our area. So you saw we have a very limited inventory. We are 10 to 12,000 homes less than where we should be. Okay. Now, take higher interest rates, but we still have that pent-up buyer demand, which is keeping everything at value. We drop the mortgage rates, a lot more buyers are going to come into the market. It's going to drive our prices a little bit higher, pull our inventory down even further, and then we're going to start running into what we had in 2020 and 2021. Keep that in mind. All right, as we move on, remember, the good news is they have stopped that crazy, additional points or fees if you had good credit or, debt to income ratios and things like that, that people were, well, it just didn't go over so well. They've always charged it. I don't know why the media got a hold of this. Yes, the problem is that the concept was sound. It's just how they were doing the calculations was just crazy. And then, of course, everybody had a freak out. So this actually helps everybody that is not putting 20% down, just FYI. So that balance will probably resurface again, probably in November. Don't be surprised if you see something like it. And in the meantime, you betcha, smash that subscribe button, share and like the channel. Ask your questions. We love questions. Give us questions. And again, there's no strings attached. There's no selling. The goal is that you are able to make the best business decision possible when the time is right. And that's what all this is, okay? If you have questions, reach out. In the meantime, you guys have an absolutely beautiful day. And I will talk to you guys later. Take care.